All right, let's dive into something that's, well, it's one of the most powerful but also most misunderstood ideas in all of trading. We're talking about market liquidity. This is the hidden force, the real engine behind why prices actually move. And today, we're going to pull back the curtain and show you exactly how it all works.
I mean, come on, you've been there, right? You set up what looks like the perfect trade, you did all your homework, you found a great entry, you even set a responsible stop loss, and then it feels like the market has a personal vendetta against you.
Oh, you know the feeling. You hit buy, the price drops just enough to tag your stop loss, and then boom, it skyrockets in the exact direction you knew it would go. It is so frustrating, right? You're just left there staring at the screen thinking, what just happened? Well, the answer to that what is liquidity.
So what in the world is liquidity, really? Let's break down this force that's behind that whole frustrating scenario we were just talking about.
You know, at its core, it's actually pretty simple. Liquidity is just pools of buy and sell orders that are all clustered up at specific price levels. The best way to think about it? It's like fuel. For the market to make a really big, powerful move, it has to go where that fuel is. And to get why the market needs that fuel, we just have to go back to the absolute basics. Prices move because of supply and demand. It's that simple. Think about selling a house. If 100 people show up desperate to buy it, what do? You jack up the price. That's high demand. But if nobody's interested, you got to drop the price to get a buyer. The financial markets, they work on the exact same principle.
And this leads us to something, a really crucial point that so many traders just completely miss. What actually is a stop loss? It's not some magic shield protecting your account, no. If you're in a buy trade and you place a stop loss, that stop loss is nothing more than a preset sell order just waiting there. And if you're in a sell, your stop is a buy order. Getting this is a total game changer because it shows you exactly where those pools of orders, that market fuel, are hiding.
Okay, so now that we get that, let's use this idea to bust our first big myth. The idea that support and resistance levels are some kind of impenetrable wall.
The old-school conventional view tells you to sell at resistance and buy at support, right? The ceiling and the floor. But the liquidity view, it flips this whole thing on its head. A resistance level isn't a ceiling, it's a magnet for price. Why? Because that's where all the stop losses from sellers are sitting as buy orders. And it's the exact same story for support. It's not a floor, it's a giant pool of sell orders from all the buyers who have their stops clustered right below it.
So why does the market get drawn to these areas like a magnet? Look, it's not because some big institution is personally hunting your stop. Honestly, they don't care about your trade. They just need to fill enormous orders. And to do that without messing up the price, they have to go where there are tons of counter orders to trade with. Those obvious support and resistance levels, they're the most efficient places to find all that liquidity and get their business done.
Okay, so this is the million-dollar question, right? How do you tell the difference between a simple liquidity grab and a real, genuine change in direction? It all comes down to the candle. A liquidity sweep, that's when the price just pokes through a high or a low with its wick. It's like a quick jab. It grabs the orders and then snaps right back. The key is the candle body closes back inside the range. Now, a true break of structure, that's totally different. That's when the candle body closes firmly, decisively, outside that level. That's the market showing its hand, telling you there's real commitment behind that move.
All right, next up we're going to tackle another sacred cow of technical analysis, the trend line.
So the common wisdom is, oh, the trend line broke. It's a reversal. Time to sell. But in reality, what it often creates is a trap. All these traders see the break and they pile into short positions, creating, you guessed it, a fresh pool of liquidity. The real question you should be asking is, has the actual market structure, that last important low, been broken? If the answer is no, then that trend line break is probably just a liquidity grab before the price continues on its way.
And this just nails it. This quote is perfect. Market structure, the highs and lows actually printed on the chart, that's real. A trend line, though, it's just an imaginary line you drew. It doesn't really exist. The market has zero reason to respect it, but it has every reason to be drawn to the juicy liquidity that builds up all around it.
So we've busted the myths. Now for the fun part. Let's put this all together and watch how a professional uses these exact concepts to build a trade from A to Z.
Okay, check this out. Here's our setup. The bigger picture, the market structure, has already turned bullish. It made a higher high, but right now we're in a pullback. And what do you see? Prices breaking below a super obvious, classic trend line. Now, to the average trader, this screams sell. To a trader who understands liquidity, this is where it gets really, really interesting.
This is what we call confluence, where everything lines up just perfectly.
First off, the main bullish structure is still intact, right? Check. We have that trendline liquidity, all the sellers getting trapped. Check. See those equal lows? That's a fake support floor just begging to be rated for stop losses. Check. And what's below all that? An inefficiency, like a little gap the market wants to fill, and a fresh, untested demand zone at the very bottom. It's the perfect storm for a liquidity hunt.
And what happens next? Well, just look. The price does exactly what we'd expect. It dives below the trend line. It sweeps all that liquidity sitting under the equal lows. It perfectly fills that price imbalance. It taps right into that deep demand zone, and then it reverses hard, leaving all those trapped sellers in the dust.
And the result of all that patience? A clean 4.42% gain. I mean, think about that. Just by understanding where the market really wanted to go, to that pool of liquidity and just waiting for it to happen, you get this kind of result. That right there is the power of shifting your thinking away from those old retail ideas and towards market reality.
So, what's the big takeaway from all this? It really is about a fundamental shift in how you look at a chart.
So here's the most important point. Most traders are trained to find levels where the price might stop, where it might turn around. They're looking for floors and ceilings. But from now on, I want you to do the opposite. I want you to start looking for the pools of orders, for the fuel, and ask yourself this one simple question. Where is the market incentivized to go? And the answer almost every single time is to the liquidity.
Just remember this. The market is on a constant hunt for orders. It's always looking for liquidity. So the only question is, now that you know what it's looking for, where are you going to be looking? Thanks for joining me.